Hello again, and welcome to VAT Update from Tax Essentials for Advisors. In this episode, we'll start with looking at an update to HMRC's guidance on postponed VAT accounting. We'll also take a look at a cautionary tale about international sales of goods, which effectively left a taxpayer out of pocket for both UK and German VAT. And we'll give you the essential recap of all the key VAT announcements from the budget, of which, contrary to popular opinion, there were actually a few. First, then, some updates to HMRC guidance on postponed VAT accounting, or PVA as it's affectionately known. A recap of PVA: it was introduced post-Brexit to address potential cash flow problems resulting from EU imports. Under postponed VAT accounting, instead of having to pay or defer import VAT at the border when goods are imported, a VAT-registered business can choose to use PVA and instead self-account for import VAT on its VAT return. In many instances, this will end up being a simple in and out administrative entry on the VAT return and won't give rise to any VAT liability. It avoids the problem of having to fund the VAT at the border and then reclaim it a little bit later down the line via the VAT return. Remember that if someone, like a freight forwarder, imports goods into the UK on your behalf, you need to tell them in writing that you want to use postponed VAT accounting so that they can include this on your import declaration and make sure you keep a written record of that instruction. HMRC has now published a useful new landing page on postponed VAT accounting, which brings together all of its guidance on PVA in one place and includes guidance on when postponed accounting can be used, self-accounting for postponed import VAT on VAT returns, and postponed import VAT statements. Our only case in this edition is Express Brands Limited, and this is a cautionary tale about what a mess you can find yourself in if you get the VAT treatment wrong on international transactions. The business sold goods via Amazon for a number of years to customers in Germany. Eventually, Amazon told it that it needed to VAT register in Germany and account for local VAT, and ultimately the German tax authorities assessed the business for German VAT. In the period from 2013 to 2019, it had, unfortunately, been incorrectly charging UK VAT rather than German VAT. The business rang HMRC to tell them what had happened and was told to submit error corrections for the overpaid UK VAT. But by the time it came to submit the corrections, most of them were rejected because they were outside the normal 4-year window for correcting VAT errors. You can feel some sympathy with the business here. It was being told to pay German VAT, but also that it couldn't correct the overcharged UK VAT on the very same sales. Effectively, the sales were subject to VAT twice. The appeal centred on whether the 4-year time limit could be extended or set aside in these circumstances. But the tribunal held that the time limit rules were what they were, and unfortunately, the taxpayer could not reclaim the overpaid UK VAT. The lesson? Make sure you carefully consider VAT on international transactions, else you could end up with a double VAT hit. And remember those error correction time limits. The normal window is 4 years, and you'd be hard pushed to challenge it, even if the result seems to offend common sense and fairness. In other news then, let's take a look at some of the key VAT announcements from the budget. Now, Budget Day didn't contain anything earth-shattering to the VAT system as a whole. No fundamental changes to registration thresholds or rates of VAT, but it did include a number of sector-specific announcements that will have a real impact. Now, we speculated about a taxi tax a couple of weeks ago in advance of the budget, and sure enough, it was in there. At the moment, some operators like Bolt and Uber are relying on the Tour Operators Margin Scheme, or TOMS, to reduce their VAT bills, such that they only have to account for VAT on their profit margin. There's ongoing litigation going to the Court of Appeal with Bolt on this, but HMRC has decided to put the issue to bed for the future by specifically excluding private hire vehicles and taxi services from the TOMS from the 2nd of January 2026. This means that where the private hire company acts as principal, they will be required to account for VAT on the full payment received from the customer. There's some good news in the budget for businesses wanting to donate goods to charity. For years, the VAT business gifts rules have been an impediment to donating surplus goods to charity. Often, businesses were faced with a choice between throwing the goods away or paying VAT at 20% on the donation. Now, The government will introduce a VAT relief or zero rate on donations of business goods to charity from 1st of April 2026. There will be some nuance to the rules and there will be some value thresholds so that high value luxury goods being donated don't escape a VAT charge. In addition, there's some big news for partly exempt multinational groups in the budget, particularly those in the financial services sector. HMRC has changed its policy on how the VAT grouping provisions affect supplies between branches of the same entity. At a really high level, the previous policy could result in VAT charges arising where there were charges into the UK from overseas branches of the same legal entity. This shouldn't happen under the revised policy, and it looks like HMRC will be paying some refund claims going back into the past. Finally, there was a tweak to the VAT rules around the Motability leasing scheme. The effect of these changes, which come into effect from July next year, will be that VAT will become due at 20% on advance or top-up payments for a vehicle under Motability. That's all for this one. I look forward to our further update in a couple of weeks' time.
That was a really insightful update. Thank you to Ed Thompson, Chartered Accountant and Chartered Tax Advisor, and the latest addition to our growing team of expert commentators here at Tax Essentials for Advisors. Developed to meet your needs as a tax professional, Tax Essentials for Advisors is also CPD accredited. It's crammed with practical advice, concise yet extensive commentaries, the latest news, access to a free helpline, plus all the tools you need to deliver an outstanding service to your clients. To arrange a no-obligation demo, get in touch using the details shown here.